Greetings, great learners. My name is Mr. Simbi and welcome to today's accounting class. In today's class, we're doing the statement of financial position, but we're focusing on our non-current assets. So I'm going to be talking about fixed deposits as well as our fixed tangible assets. We're going to start off with our fixed tangible assets, and what you see on your screen is note 3. And we are going to start off with our land and buildings. So we are given an amount from the pre-adjustment trial balance. This is only an extract. And then we have 275,000. More information reads, the following transactions involving tangible assets took place. Extensions were done to the building to the value of 75,000. JT Builders was paid by EFT and it was not recorded in the books. So we would then come here, then we say the cost at the beginning of our land and buildings is 275,000 here, 275,000. We don't have accumulated depreciation on our land and buildings. Therefore, our carrying value will be 275,000. We come now to our movements. Additions are 75,000. So we come here, we have additions of 75,000. The extensions that were done to the building will be recorded as the additions. There will be no depreciation. Therefore, we come now to the cost at the end. So we say my cost here plus my additions at cost gives me my cost at the bottom. 275 plus 75 gives you 350,000. Then, accumulated depreciation is not there. Therefore, the carrying value will be 350,000. This is how we would record in note number 3 when it comes to our land and buildings. Very important to note that when we have done extensions, that amount will be recorded as your additions. There it is, when it is neatly typed off. Now, let's go on to the next one. The next one has to do with our vehicles. It says, this is a pre-adjustment trial balance extract. So we have vehicles and accumulated depreciation. Provide for depreciation as follows. Motor vehicles at 10% per annum on the diminishing balance method. All right? So in this case, we are not given any additions to the vehicles. This should be very easy. So I'll come, my cost at the beginning is 40,000. So I'll come here, it is 40,000. My accumulated depreciation is 16,000. Therefore, our carrying book value becomes 24,000. It is your 40 minus 16 to give you your 24. We have no additions, but we need to calculate depreciation. Depreciation is being calculated on the diminishing balance method. That means we calculate our depreciation on the carrying value. So my carrying value, I already have it, 24,000. So I'll take my 24,000, multiply that by 10%, multiply that by 12 over 12. That will give me 2,400. So when I come to my depreciation, I know it must be in brackets, and it is 2,400. I'll then come to the end. My cost will not change because there is no addition. So my cost will remain 40,000. But my accumulated depreciation is going to change because I had 16 at the beginning, 16,000. And this year my assets have lost value, 2.4 plus 2,400. So in total, I have 18,400. 40 minus 18.4, that would give me 21,600. That therefore becomes my carrying value at the end of this year. All right, I want you to look at it again on the typed version. Here's my depreciation, and my carrying value becomes 21,600. 600. Okay. Let's go on again and we look at our equipment. The information, we're given the amount from the pre-adjustment trial balance and then provide for depreciation at 20% per annum on cost. Equipment costing 37,000 was purchased, so we have new equipment here now. On credit on 30 November, very important to note, 30 November, no entries have been recorded. So we have our equipment at the beginning. How much is equipment at the beginning? 49,500. So I'll come here, cost at the beginning, 49,500. There is the cost at the beginning. My accumulated depreciation is 3,200. So I'll come here, I have my 3,200. Therefore, I get carrying value. And my carrying value therefore becomes 46,300. Additions. Do I have any additions? Yes, 37,000. My additions become 37,000. When you are now calculating your depreciation, it is important to consider that you have the old, here is the old, and you also have the new. You have the old and the new. So, on the old one, its cost is 49,500, 49.5. You remember, there it is. We're using the cost price method. So I'll come here on the old, I'll say 49.5. Multiply that by 20%. That is the depreciation rate, 20 over 100. Then I'll say multiply that by 12 over 12. That is the number of months that we had the asset for. So it becomes 9,900. I'll come here on my depreciation, I have 9,900. But this is only for the old. I need depreciation for the new as well. So my new one is for 37,000. Remember this one. So come here and I'll say 37,000. Multiply by the depreciation rate is 20 over 100. But for how many months did I have it? When did we acquire it? 30 November. That means in the month of November, we did not use this asset. We only used it from December. And then we on to January, February. The financial year ends on the 29th of February. So we had it for 3 months. So come here and say multiply by 3 over 12. 3 over 12. How much then becomes the depreciation? So we say 37,000, punch that in your calculator, multiplied by 20%. And then you multiply that also by 3 over 12. That gives you 1,850. 1,850. So I'm coming here to say plus 1,850. Plus 1,850. So if you come here then, you add your 9,900 plus the 1,850. It gives you 11,750. 11,750. The cost at the end becomes easy then because you have your 49,500 plus your additions, which is 37,000. So it gives you 86,500. Your accumulated depreciation, you say 3,200 plus 11,750. Then you end off with 14,950. Your carrying value, remember, you then say 86.5 minus 14,950. That gives you 71,550. That becomes your carrying value at the end of the year. When you have these calculations, I'm going to show you on the typed version. And then after that, let's move on now to where we transfer all our amounts. When we're transferring all our amounts, we are now adding. We're taking our carrying value. So we're adding 350 plus 21.6 plus 71,550. Let me give the figures again to you. It is your land and buildings, 350,000. Then you add your vehicles, 21,600. Then you add your equipment, 71,550. You are adding your carrying value. That will give you a total of, okay, let me give the figures again to you. It is your 350,000, that is for your land and buildings, plus the 21,600. That will be for your vehicles. And then you must add equipment, 71,550. And then you have 443,000 here, 443,150, 443,150. Remember, you are adding your carrying value at the end of the year. There it is, 443,150. Then, a part of the fixed deposit at AB Bank matures on 30 June. All right, so remember the financial year must end in February. Then just after February, March, April, May, June, in 4 months' time, the fixed deposit is going to mature. So it's maturing within 12 months because it's maturing after 4 months. Therefore, it will cease to be non-current asset and it will become a current asset. So we will then come and then we say, under our financial assets, I must have the 95,000. Here's my 95,000. Then I subtract the part that is going to mature, 45,000. 95 minus 45, that gives you 50,000. Then you have 443,150 plus 50,000, that gives you 493,150. All right. Once you have done this, then you have been able to calculate your depreciation in note number 3, and you now understand when a fixed deposit matures, a part of it, it will cease to be a non-current asset and it will go to your cash and cash equivalents. Dear learners, let's go for a net break and I'll see you shortly.